Geoffrey, the dollar story has been huge for a long time now because, yes, we know that dollars are in vogue and attractive if we see a big interest rate differential between the U.S. and other parts of the world. But this dollar story, is it going to help the Fed in this situation tamp down inflation? Is this something that we should be watching as a headwind for companies here in the U.S., especially those with multinational exposure?
So put it this way, yes, it could be a headwind, but compared to the rest of the world, not as much. The U.S. economy is far less sensitive to tightening in financial conditions from the exchange rate compared to trade-heavy economies. We're looking at the likes of Switzerland, Japan, Eurozone even, and a lot of emerging markets. Global commodities are priced in dollars. So from their own point of view, stronger dollar in this environment, not good for them at all.
So if that's the case, that's one of the things that we were talking about over the last several weeks with regard to the value of the dollar. This idea that you price so many commodities, gold, crude oil, nat gas, you name it, in U.S. dollars. In the past, from a fundamental standpoint, a rising U.S. dollar value has acted as a headwind for some of those commodities. I'm speaking specifically with regard to crude. Why do you think that the rising U.S. dollar has not put the brakes on some of these commodity markets, the red hot ones?
Well, this time around, it's clearly a supply issue, and markets are trading like that. These supply issues are not going to go away anytime in the near future. We can have a boost in production, from OPEC Plus, for example, but these intrinsic problems, the supply and demand imbalances, that's not going to go away anytime soon. And also take China, for example. People talked about China reopening as if it were a good thing. Well, I'm not so sure. Yes, you get China reopening. That's good for people who export to China. But that's going to lead to a rise in oil demand and also general commodity demand that's priced in dollars. And that's going to exacerbate the supply issues that we're seeing as well. So right now, we're in a tough spot. Central bank has been saying globally, we can do as much as we can. We can raise interest rates. We can't print oil.
There's a lot more talk right now, specifically in the last 12 to 24 hours, about this idea that the Federal Reserve here in America has to raise rates more aggressively, specifically by 75 basis points, perhaps even tomorrow. What does that do to the dynamic of the U.S. dollar versus many of those currencies I just reeled off? How does that change the exchange rate going forward? And will it be a scenario where the U.S. dollar continues to be that kind of safe haven trade, that currency of choice, that reserve currency going forward?
In the short term, yes, people want to own dollars. They know that despite valuations, things do look cheap elsewhere. But as long as the Fed's driving things, and we're looking at 75, but also in terms of terminal levels, the market has to price in the prospect of 4%. Until we get there, I think the dollar is going to stay bid. But on the other hand, it also opens up scope for the likes of the ECB, S&B, Bank of England to perhaps do a bit more as well to support their own currencies. So when was the last time we talked about the Swiss raising interest rates, right? Their old target rate, 3-month LIBOR in Swiss franc, that doesn't even exist anymore. And for the BOE this week, 50 is possible as well. So it really goes both ways. And if the other currencies, if the other central banks can be a bit bolder in pushing for appreciation, letting their own currency strengthen to rate hikes, I think that can help address the balance as well and maybe cap the dollar. But for the time being, I think most portfolio managers, most investors, they want to stay overweight the US dollar.